Expecting the unexpected. Systemic risk. In the world of investing, risks are ever present, some more apparent than ever. However, some risks are like ticking time bombs, waiting to unleash chaos on the financial markets. One such risk is systemic risk. Warren Buffett touches upon this in his 2016 shareholder letter, stating, "The years ahead will occasionally deliver major market declines, even panics, that will affect virtually all stocks. No one can tell you when these traumas will occur. Not me, not Charlie, not economists, not the media." Meg McConnell of the New York Fed aptly described the reality of panics. We spend a lot of time looking for systemic risk. In truth, however, it tends to find us. So what is systemic risk? Systemic risk refers to the risk that can cause a collapse or severe instability in the financial system. If you've experienced life from 2019's COVID, this is exactly the kind of risk Buffett is talking about. Crises are an example of a systemic risk that can affect an entire market, not just a particular company or industry. It's like a domino effect. When one financial institution faces a crisis, it can quickly spread throughout the financial system. And just like Buffett mentions, no one can predict when these systemic risks will hit the market. They are often triggered by a combination of factors, including economic, political, or even natural events. The unpredictability of systemic risk makes it particularly dangerous, as investors and institutions may not be prepared to handle the fallout. Despite the efforts to identify and mitigate systemic risk, it has a way of catching the market by surprise. This is because systemic risks are often unisolated events, but are interconnected with various but obscure elements of the financial system. When one domino falls, it sets off a chain reaction. Therefore, it can be difficult, if not impossible, for even institutions to protect themselves from systemic risk. Yet, the unexpectedness of systemic risk doesn't mean it's impossible to prepare for it. And one of the easiest ways to guard against systemic risk is by simply holding cash. When the market is in turmoil, cash provides the flexibility and the option to take advantage of opportunities that arise. It's like having an umbrella when it rains. It gives you the ability to navigate through the storm. Buffett himself is known for holding significant amounts of cash in Berkshire Hathaway's portfolio for this very reason. Systemic risk is like a storm that no one can predict with certainty. And as Warren Buffett and Meg McConnell emphasize, it's not easy to look for systemic risk. It's about recognizing that it can find us at any time. By holding cash for such days, we can find that it unexpectedly becomes a strategic move that can provide a safety net and opportunities during market downturns.